Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you're having a very good day. Markets a little on the quiet side. We've seen a bit of a correction down in gold. Oil has remained very strong, as I've been suggesting for a while, and that will be on the Fed's radar as well. But in markets generally, equities are a little bit mixed, trying to find their feet today. And remember that 11 straight days of gains for the Dow Jones, it's really a case, or the US stock market, it's really a case of range trading. And the first day was at the bottom of the range, the market's still range trading. The second day was a little bit higher, market's still range trading. Third day, the close was a little bit higher. So those closes may have been 11 days, but market's been going sideways for 3 or 4 days now. So just bear that in mind when it feels like it's still ticking higher. Of course, no run lasts forever, but there could be a fresh impetus this week. If I'm wrong about the Federal Reserve and they say, look, we think we're done for now, markets will most definitely explode to the upside. I still think, however, the more likely scenario is that they will be very staunch, stubborn, and affirmative about the idea that they still maintain a bias to hike rates until inflation is clearly defeated. And that it is not as yet, because that core inflation number actually reaccelerated in the last month. The services sector, the Fed remains very concerned about, and wages could be accelerating as well, and the Fed's very concerned there too. And on top of that, now we have some commodity prices, again starting to move towards the upside, and that includes natural gas and gasoline prices in the USA, and that could well rekindle consumer expectations as well as the headline inflation number. The Fed, of course, will see its job as largely done, but not yet complete, perhaps. So it will be a pause after this rate hike by the Fed, and for all of those reasons, it is probable that the Fed will raise rates a further 25 points, but then it should be on hold. And again, I'll just re-emphasize, and I'm sorry if I'm repeating myself, but I've said all along that once the Federal Reserve gets to its terminal rate, it could well be there for 6 to 18 months, and I'm starting to think it's more in that latter half of that scenario, that 12 to 18 months is what we could see in terms of federal funds rate staying high for an extended period of time. This, of course, will weigh on the US economy, and we saw some data out yesterday, particularly concerning was the Chicago Fed National Activity Index. So it's an index for national economic activity, and that was in contraction for the second month and has been in contraction for most of the last year. So there's a real weakness to the US economy that should not be neglected either when assessing one's investment portfolio at this time. And also we know that commercial property in the US is in real trouble. And we're hearing reports today in Australia, for instance, that Grosvenor Place building is 30% vacant, and that's just completely unheard of. And there's still a lot of office building going on in the Sydney and Melbourne areas when vacancy rates are actually starting to increase rather than move to the downside. So that return to the office process may well be complete, but nowhere is it more stark than in the United States, where cities like San Francisco, Detroit, even LA are being hollowed out. And in New York, there are problems as well, particularly with high-end residential properties, where you're not seeing people as willing to really permanently locate to New York as they once were. So around the world, but particularly in the United States, and we're starting to see the same trend in Australia, commercial property, city living even, is starting to be hollowed out a little bit. So there was that, like as with the economy, there was that post-COVID boom, but then we're starting to see an oscillation now for moderation of those forces on a whole range of fronts. So the US economy, I like to sort of, well, I don't like, but I do think it's important to point out is dysfunctional to a significant degree. The Federal Reserve is probably thinking it would like to see the US economy crunched a little bit further because it doesn't feel that inflation is under control yet. I'm going on about this quite a bit in the last few days, but it is all important to market sentiment going forward, just how that accompanying statement is phrased. And of course, the market will try to put positive spin on that, but nevertheless, I think we need to be cautious after such strong gains in equity markets that there is a vulnerability to the downside and also the potential for a fresh new bullish wave. So I'd be a little bit cautious ahead of that Fed statement, and I'd take with a grain of salt the immediate positive spin on that statement, and then we'll reassess the next day, of course, and bring you our latest views. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.